Welcome back to the Deep Dive. Today, we are on a pretty critical mission.
Yes, we are.
We're trying to find those few elite companies that really earn the title of all-star dividend stocks.
It's a small club.
It is. And we've pulled together sources that go way beyond just, the basic definition of a dividend.
Right.
We're looking at the big picture, the macroeconomic forces driving money into this space right now.
And more importantly, the actual formula, the specific traits, the signals you need to spot to find what our sources call true compounding machines.
It's fascinating because market fads, they come and go.
Yeah.
But dividend growth investing, it's all about that power of compounding.
It's constant, and our sources really echo Warren Buffett on this. He's the one who famously called these consistent dividend growers the, quote, secret sauce for monster gains.
And the data totally backs that up.
Completely.
The history here is just undeniable. I mean, if you look back since the 1940s, dividends have been responsible for over a third of the S&P 500's total return.
It's over 1/3. It's an engine.
It's a massive engine for wealth creation. You really can't afford to ignore the power of those growing payouts in a long-term strategy. Good luck investing without them.
Yeah, good luck.
Okay, so let's start with right now. The sources are pointing to this major flow of capital moving into dividend growth, and they think it's going to get even stronger heading into 2026.
Mm-hmm.
So what's driving this big rush?
Well, you have to connect it directly to Fed policy. I mean, the Federal Reserve is cutting interest rates.
And the consensus is that more cuts are coming.
That's right. And this isn't just, some abstract economic news. This dictates where huge pools of capital are forced to go.
Okay, break that down for us.
Well, just think back to 2022. The Fed started hiking rates pretty aggressively.
Right.
So capital flooded into safe havens, things like money markets where you could get a safe yield north of 3.5%.
It was a no-brainer at the time.
A complete no-brainer trade.
And we are talking about a gigantic amount of money here, right?
Yeah.
What's the size of that pool that's just kind of sitting there?
It's about $7.5 trillion. That's the figure from our sources.
Wow.
It's an ocean of capital. But the problem for all that money is that as the Fed cuts rates, well, those juicy yields start to disappear.
Okay, so the logic's pretty simple then. If you're managing some of that $7.5 trillion and your safe 3.5% return starts dropping towards 2 or even 1%.
That money has to find a new home.
It has to look for income somewhere else, ideally with some growth attached.
Precisely. That capital is now actively hunting for growth that also provides sustainable income. So these dividend growth stocks, the companies that reliably raise their payouts, they become just exponentially more attractive when those risk-free rates are falling.
And beyond just the rate environment, the sources make an even bigger point. They argue you can't afford not to own these stocks because they act like a safety net.
A critical safety net during market stress. They provide this profound stability edge when volatility really spikes.
And the historical data on this is pretty clear, isn't it?
Oh, it's compelling. I mean, we looked at the data going back to 1975. In basically every single instance where the S&P 500 had a correction of 10% or more.
Which happens.
Oh, it happens. Dividend-paying stocks outperformed the broad market. Every time.
And the sources get really specific about how much better they did.
They do. During those big corrections, the dividend payers outperformed the S&P 500 equal weight index by 5.5%.
And that equal weight index is important, right?
Yeah.
It's not just the mega caps skewing the numbers.
Exactly. It removes the size bias of the biggest companies, so it gives you a much truer picture. It shows that the outperformance is really widespread among dividend payers.
But then you get to the really big number when you compare the companies that pay a dividend versus the ones that pay absolutely nothing.
The difference is staggering. It's nearly 14%. 13.7 to be exact. Dividend payers crush the non-payers during those periods of heightened fear.
So it's not just about getting a little check in the mail every quarter.
Not at all. It's about owning companies that give you superior relative performance when everyone else is panicking. It makes them sort of a foundational piece of a really resilient portfolio.
Okay, so if the benefits are that clear, we need to know how to find the best of the best. Because the sources are very clear on this. Don't just go chasing a high yield.
Yeah, that's a classic value trap.
So what are the traits? What defines one of these all-star companies?
The authors define the strategy as the Holy Grail.
The Holy Grail.
And that is owning high-growth businesses that consistently, reliably increase their payouts every single year. It's that rising payment plus the stock appreciation that creates that explosive compounding effect.
So where does the formula start? What's the first trait?
It starts with key trait number 1, which is all about sustainability. And you measure that with the payout ratio.
The payout ratio. Let's make sure everyone's clear on that. What is it, and what's the magic number we should be looking for?
Sure. The payout ratio is just the percentage of a company's net income that it pays out as dividends. Simple as that. So if a company earns $1 per share and pays out 50 cents, your ratio is 50%.
Got it.
And the sources strongly recommend focusing on low payout ratios, ideally below 40%.
And why is that sub 40% number so important?
It's all about safety and flexibility. A low payout ratio gives management this huge cushion.
Right.
It means they have plenty of room to keep lifting those payouts year after year, even if the business hits a rough patch. It signals financial discipline, it signals durability, and that is exactly what big institutions look for.
Which leads us right into the second key trait.
Yeah.
You have to track institutional buy pressure.
Absolutely. You need that external validation. It's the essential second step. You have to spot where Wall Street's money, that institutional money, is actually flowing.
Because they're not buying average companies.
They latch on to the best, most sustainable growth stories in the world. And their consistent buying pressure is what helps push those shares higher. If you can track those flows, you get a powerful confirmation that the business quality is real.
And according to the sources, that institutional money is already flowing. Let's look at the sectors that confirm the trend.
Yeah, the recent thrust is heavily concentrated in areas with strong growth and reliable dividends. Healthcare is the runaway leader right now.
How much is the inflows?
31% of the inflows mentioned in the sources, with an average yield of about 1.6%. Then you have financials with almost 14%. Even energy is seeing big flows.
And just for comparison, what's the S&P 500's yield right now?
It's just over 1%, 1.09. So you can really see where investors are moving their capital to find that income.
Okay, this is where the rubber meets the road. Let's use the specific example our sources flagged in healthcare. The top inflow leader, Eli Lilly, ticker LLY.
Right. LLY was identified as having massive institutional interest. It commands a really high proprietary MAP score of 82.8.
And that score, just to remind everyone, combines those two key factors we just talked about.
Exactly. Rock-solid fundamental traits and confirmed institutional demand.
Okay, so let's look at the fundamentals. This is a nearly $1 trillion company. What do the growth projections look like?
The numbers are just extraordinary. The sources project massive growth. Revenues surged to $45 billion this year.
Wow.
And they're estimated to climb all the way to $75 billion by 2026.
And what about net income?
That's pegged to jump from about $10.6 billion to a projected $28.2 billion in 2026.
That's the engine.
That is the engine. Those numbers guarantee the company can easily sustain and increase its dividend, all thanks to that explosive profit growth.
And this brings us to that really interesting paradox we talked about earlier, the power of compounding. The sources note that even though Lilly has consistently raised its dividend every year, its current dividend yield is actually shrinking. It's down to 0.64%. Why is a shrinking yield actually a great sign here?
It is the perfect problem to have. A shrinking yield means the stock price appreciation is so aggressive, it's literally running away faster than the company can raise the cash dividend.
Which is what you want.
It's exactly what you want as a long-term investor. You want the stock's growth to far outpace the dividend because that's where the real wealth is generated.
Yeah.
This is the ultimate combination of explosive growth and rising, reliable payouts.
So last piece of the puzzle. What about the institutional confirmation for LLY? Did tracking those flows actually work?
It absolutely did. The sources noted that LLY shares have gained a staggering 911% since the very first time it appeared on their institutional tracking report.
Wow.
It just confirms the power of the formula. Find the all-star fundamentals, low payout ratios, high profit growth, and then confirm it with that sustained institutional buying.
And that really brings us to the core takeaway here. Finding these all-star dividend stocks, it's not about chasing the highest yield today.
No.
It's about identifying all-star businesses that are loved by institutions. You have to prioritize that long-term growth and dividend sustainability, that low payout ratio.
Because that's what ensures the compounding over time. And you have to remember the macro shift we started with. As the Fed lowers rates, that $7.5 trillion needs a new, sustainable home. You should be prepared for dividend growth companies to perform extremely well as that capital goes looking for returns.
So the sources were basically telling us the time to identify these companies is right now. Don't wait for the mainstream media to blow the bull whistle on this trend.
The goal is to be early, to ride that compounding wave as the capital starts to shift.
So here's a final thought for you to explore. Knowing that the stock price appreciation, not just the quarterly check, is the true engine of compounding wealth. How might shifting your focus from current yield to long-term profitability and institutional flows change the next company you choose to research?